Is the Bank of England crashing the economy? One of the world's oldest and most significant financial organizations, the Bank of England, BOE, shapes UK economic policy. It greatly affects inflation, growth, employment, and consumer confidence. Recent years have seen controversy engulf the BOE. Critics claim its plans may cause an economic decline rather than growth. This video will examine the BOE's recent monetary initiatives, the UK's economic issues, and whether they are causing economic turbulence. Number 6. The mission and fundamental duties of the Bank of England. The Bank of England, established in 1694, has a persistent objective of preserving monetary and financial stability in the United Kingdom. Over the years, it has developed into the foundation of the nation's economic structure, tackling issues from inflationary surges to recessions. Its primary functions include: the Bank of England employs the bank rate as its principal instrument to regulate borrowing, lending, and general economic activity. Inflation management. The main objective is to attain the government's inflation target of 2%, thereby guaranteeing price stability. The Bank of England regulates and modifies the money supply to achieve equilibrium between growth and inflation. The Bank of England guarantees the seamless operation of the banking system and the mitigation of financial shocks. The Monetary Policy Committee (MPC), comprised of economists and financial specialists, convenes periodically to determine interest rates and other measures. These choices are essential in shaping the course of the UK's economy. Number 5. Current economic data. The UK economy is showing signs of both revival and stagnation as of January 2025, with a complicated picture painted by a number of indicators. Trends in inflation. In 2022, global supply chain disruptions, rising energy costs, and post-pandemic recovery pressures caused inflation to jump to 11%. In March 2024, aggressive interest rate rises helped bring inflation down to 3.2%. Recent data, however, indicates that inflation is gradually returning to 2.5%, and projections indicate that it may surpass 3% by the middle of 2025. We attribute this revival to the continuous rise in wages, high energy costs as a result of unstable geopolitics. There are still bottlenecks in the supply chain that have not completely normalized. Economic growth that is stagnant. Since the middle of 2024, GDP growth has stalled, and the UK economy has had difficulty picking up steam. Growth was level at 0% in the third quarter of 2024, signifying a period of stagnation. Weak consumer spending as a result of growing living expenses is one of the factors behind this stalemate. The economic uncertainty has led to a decrease in corporate investment. The international economic climate remains precarious. Obstacles in the labor market. Although the labor market was resilient at first, there have been indications that it is becoming weaker. Layoffs are happening at the highest pace since the COVID-19 epidemic, and job losses have escalated. Despite being strong, wage growth is decreasing and isn't keeping up with inflationary pressures in certain industries. Growing joblessness in sectors like construction and retail is indicative of more general economic hardship. There has been a decline in consumer trust. One important economic indicator, consumer confidence, plummeted in January 2025, reaching its lowest point in more than a year. Household concerns include the possibility of high interest rates leading to increased borrowing expenses, increasing costs for necessities, uncertainty about the state of the economy in the future. Number 4. Decisions on monetary policy. Examining the BOE's activities. Changes in interest rates. The BOE reduced its bank rate by 25 basis points to 4.75% in November 2024, which was just the second rate drop in 4 years. following a protracted sequence of rate increases meant to counter double-digit inflation. This decision was made. The rate is still at 4.75% as of January 2025. But the BOE is under pressure to lower it even further, with markets anticipating a drop to 4.5% in February. Rate cuts, according to critics, could indicate a lack of faith in the economy. Discouragement of foreign investment could potentially lead to a decline in the value of the pound. In the face of more significant structural difficulties, provide a restricted amount of stimulation. Tightening quantitatively. In order to reverse years of quantitative easing QE during the epidemic, the BOE is simultaneously enacting quantitative tightening. Reducing the BOE's bond holdings, which hit all-time highs during the crisis, is part of QT. QT has generated controversy. Despite its goal of normalizing monetary policy, the BOE has lost an estimated £100 billion due to its bond sales. Number 3. Remarks and issues. Various people have criticized the BOE's policy, pointing out possible dangers and unforeseen consequences. Interest rate reductions, a two-sided sword. Lower interest rates are intended to encourage borrowing and spending, but if they are seen as a reaction to economic weakness, they may potentially erode consumer confidence. In a setting with high living expenses and unstable economic conditions, lower interest rates fail to significantly increase demand. Tightening quantitatively. Too much? Too soon? Given the state of the economy, several analysts contend that the BOE's QT policy is premature. The BOE runs the danger of raising long-term borrowing rates by lowering its bond holdings, which would discourage investment and consumption. This could potentially increase the financial strains on the government due to increased debt interest payments. Number 2. Supporting the actions of the Bank of England. Despite the criticism, supporters of the BOE's activities point to the program's long-term advantages. Controlling inflation, the top priority. The BOE's cautious interest rate policy aims to prevent inflation from spiraling out of control. Low-income families are disproportionately affected by high inflation, which reduces their buying power. The BOE aims to stabilize inflation expectations and prevent economic instability by maintaining a balanced posture. We are bringing the policy back to normal. Following years of stimulus, the BOE's QT initiatives are a component of a larger plan to return monetary conditions to normal. QT is required to prevent asset bubbles that might endanger financial stability, even if it is unpleasant in the near term. Restock the Bank of England's policy toolkit for future emergencies. Number 1. Broader context, challenges from outside. It's crucial to remember that a lot of the UK's economic problems are caused by outside forces that are beyond the BOE's control. Geopolitical tensions. The war between Russia and Ukraine is one example of an event that has upset the world energy markets and raised prices. Global economic slowdown. Weakness in key economies, such as China and the Eurozone, has slowed trade and investment. Brexit aftershocks. Trade disputes and decreased labor mobility continue to impact the UK economy. In conclusion, in a volatile climate, the Bank of England must balance growth, inflation, and financial stability. Despite criticism of its methods, the issues remain complex. One's perspective affects whether the BOE is crashing the economy. Critics say its restrictive policies worsen economic stagnation. The BOE is stabilizing inflation and normalizing policy, say advocates. However, BOE decisions will affect the UK's economy. To guarantee its policies benefit society, the organization must constantly debate and review. Hit like, share, and subscribe for more.